let me bring on board both our guests. We have Feroze Azeez with us, Deputy CEO at Anand Rathi Wealth. First off, to start this conversation, good afternoon, Feroze. You know, you've spoken to us in the past at least about how small mid-cap valuations have started to get slightly overheated last quarter, if I recall our conversation. Let me first take it to the benchmark. Do you believe that valuations still looking decentish because we are at mean valuations?
Good afternoon. I think, like you rightly pointed out, there is exaggeration in valuation. There has been re-rating. I think it's, if you look at the valuations of several companies, they are even 3 sigma greater than the average PE they've commanded, assuming PE is a reasonable barometer for valuation. That's point 1. Point 2, if you look at the full PEs of the entire index, they're quite deceptive sometimes. There are some loss-making companies who have just come into profit. They really distort the Ps, especially in mid-cap. There is 1 or 2 companies which you remove because they are at 600 P. Because they, in effect, were loss-making businesses, they've started making some profit. So it's very important to strip the index out of some of these extremes to understand the actual valuation at an index level. And most portfolios may not even have that stock in the mid-cap space. But they may have some other stocks. So point is, in the broader market, I personally believe the devil is in the detail, point 1. In large caps, you can still make generic comments, but in the small and mid cap space, going very, very bottom up is critical in terms of valuation. And I would not be wrong in saying there are some of those companies greater than 3 times standard deviation from their means.
You know, at this point about that Feroze has made with respect to the devil in the details, so you do in fact have companies like Nykaa, where your operational metrics on an operational level, profits are still very thin. So naturally, the price to earnings ratio will look extremely inflated if you consider that particular metric in this case. Even if when you consider something like a Zomato, that particular valuation again will look extremely, extremely high because it has only very recently gone into the mode of profitability. A lot of runway left for these companies to come through, and there is also a lot of anticipation with respect to profitability going forward. And even when you do see about 20% revenue growth in terms of profitability, there is a lot of expectation built into the kind of, well, prices that you're seeing on these share prices.
So you've spoken of broader markets and pockets therein where valuations are slightly elevated. Some beyond the 3 standard deviations beyond their typical valuations, mean valuations. Talk to us about the benchmark itself, because what most analysts on the street seem to be suggesting is that the benchmarks don't look too overvalued despite us hitting record highs. And just talk to us about whether earnings can continue to catch up in terms of what's the earnings growth like, because we've seen a very solid earnings growth cycle. Can that continue in your view on the benchmark?
Yes, so of course, earnings is something which is very, very critical, like Mayuresh Saab said. But I personally think there's also another couple of variables in the current rally which have become very, very critical. Because all said and done, there is a lot of liquidity which has driven prices up and the re-rating has happened. Liquidity explains the differential valuations of the similar stocks in the same sector. And free float also determines what kind of re-ratings are possible or what kind of de-ratings are possible. So a company with a larger free float in a pessimistic space can also have a larger correction. And on the other side, the movements on the upper side are also higher because there's very little stock. Most of the stock has been gobbled up by the index funds. Because as index funds start becoming more and more prominent, most of the Nifty company stocks, free float might be free float technically, but it's not there in the market. And it's not going to come into the market if EPFO puts 2 lakh crores more. Then 10% of that has to go to the largest stock in Nifty, right? So point I'm trying to make is, when you're evaluating a liquidity-driven rally, fundamentals would be given 60% weightage, and 40% weightage has to be given to what kind of liquidity and when is the tide turning. So there are 2-3 barometers we look at, and not that fundamentals are not important. There's nothing more important than fundamentals, but that's still 60% weight, which is why it is greater than 50% weight. But respecting liquidity in a market like this is important. How do you understand liquidity? If you ask me, is on 27th August in Indian mutual fund small cap, since you alluded to small cap, a total 170 crores came on that particular day, 161 crores in active and 9 crores in passive small cap funds. And small caps are the ones where the tide turns first. So unless I see 5 consecutive days of small cap redemptions, I would say that still people have not come to reality and mean reversion has not begun. And you would want to be the first guy to pass the pillow if in a situation like this, if the tide turns. That's one thing which we see. Second number, which I think is very interesting and lesser is spoken about it, that you get to know the cash market buying and selling net numbers for 10 different categories. Banks, PMSs, AIFs, mutual funds, all these categories have been given separately. Like yesterday, there was 1,14,000 crores of cash market transaction. And buying was also equal and selling is always equal. So for every buyer, there is the same equal rupee seller. People keep saying that there's 23,000 crores coming in the form of SIP. If there's 23,000 crores coming in, there's an equal amount of seller. So liquidity is always going to be buy and sell equal on a specific day. So you'll have to see whether the person who's buying has a discretionary mandate or not. If you gave money to a mutual fund guy, he has no choice but to buy. So who's giving the buying will help you understand who's price inelastic, and that will determine the direction of the market. So to answer your pointed question, I think earnings can continue. If you look at Nifty earnings are minus 4% for the first quarter of this financial year, but if you X oil and energy, it is plus 11%. So I'm a little hopeful, but I'm really worried about the largest component of Nifty, which is 27%, is financial services, and banks are going through some real unprecedented crunch in the deposit degrowth.
Are there any pockets at all when it comes to value in markets like these?
Yes, Argav, actually, at the cost of being repetitive, I would completely agree with Mayuresh Saab. Because what happens is, I think you have to watch it very closely of what is the impact, because the largest weightage of Nifty is not overvalued. That's the great news, and that's also the bad news, to read between the lines and figure out what actually happens. I concur that there is only 6.7% of Indian household savings is in equity. And still, India has taken the support of Indian retail in terms of funding its fiscal deficit and funding deposits. So I think that is changing because people are becoming inflation sensitive. So point one, I think banking with some degree of further correction could become a bottoming out story, and that's something which you can add on. Second, I personally think the biggest risk we run is the broader market alphas, which are about 40-50% for the last 15 months over a Nifty retracting. And that's, I think, one of the biggest risks for investors. And I personally think if you can move, if I have to give a mutual fund manager, a little investor an advice, I would say a flexi cap fund is better poised today for a retail investor than a multi-cap fund, for example, which has mandates to invest at least 25% in both these categories.
All right. It's been a very productive conversation. Thank you so much, Feroze, for joining us.